So welcome guys to another episode of Parvez's Trade. And yeah, we'll not waste any more time. Let's just get right into it. In the last episode, we were talking about how the forward and futures market work, how they distort the current financial markets, and how you can basically make some money by just understanding the dynamics of the forward and futures market with the current market price. So I'll just give you a simple example to explain what I mean. Recently, if any one of you guys follow the natural gas price markets, what happened was basically for the last month, November, the traders of the Western world, they were expecting warmer than forecasted temperatures in North America, Europe for November. So they expected a warm November. They expected less heating usage, less use of natural gas, less consumption of natural gas. And they basically made a bet on the futures market for November. And the bet was that they shorted. So last month in November, the traders had a big couple of $100,000 net short position. So a couple of 100,000 contracts. Okay, a few 100,000 contracts net short position in the natural gas futures market with November delivery. And what this meant was they were basically selling natural gas with November delivery at a price that was significantly lower than what it came out to be. So to put it simply, they expected a warm November. They expected gas prices will thus go down because consumption will decrease, so demand will decrease, and so prices will go down. So they expected to sell the November futures, sell gas at the current market price, at whatever the price was for November. And they expected, based on their warm November forecast, the natural gas prices will go down in November. And then they can buy back their sell contracts in November before expiration date at a cheaper price, right? So let's say gas prices were, so let's say now it's October. Okay, let's just assume we are in October of this year. The traders predict a warm November. They expect gas prices will keep going down because November will be warmer than forecast in European countries and North America. And so they expect gas prices will go down going into November. And so now you're in October, you're selling a November contract, sell contract. So you're buying that sell contract basically, and you're obligated to sell natural gas at, let's say, $2 per barrel, whatever volume, per unit volume. So what happens? It's October. I'm a trader. I'm expecting gas prices will keep going down going into November. I have I have bought a sell contract for November to sell gases with end of November delivery obligation with a sell price of $2. And my idea is just before expiration date comes in November, I will buy a buy contract for November at a cheaper price than $2 per unit volume. And I'll pocket the difference and I'll be able to thus close my position, futures position, and not have to deliver any gas. What ended up happening was there was a cold front in Europe and North America, and November gas prices went up. And so these traders, now the expiration date is coming towards the end of November. They have to close their position. They don't have physical delivery mechanism. So they have to close their sale contract positions by buying back gas for November and to close the position. And so they had to go to the open market and buy for November, but buy at a higher price than $2. And because there were so many such traders with so many such short positions, sell contracts, there were that just meant that when the cold front took place in Europe and North America towards the end of November and mid-November, there was this huge demand to buy up natural gas. And that was the result of these futures traders having to close their position, and because more gas consumption meant more demand. So fundamentals also were on the upside. And you'll see gas prices went up, especially around November 20 to 26. And so the natural gas contracts usually expire on November 26th. And you'll see the natural gas market, the prices went up in the last few days of November. And the reason was because of that. These financial traders betting in the futures market, they were artificially distorting the market because they made a wrong bet. And so now they have to buy back their position by going in the opposite direction. And that created this artificial price movement. So would the price have increased that much if the traders didn't have those futures position? I don't think so, because there was more than enough storage to meet any sudden cold front in November. And so, yeah, if you're trying to, for example, make money in the commodities market, you can just look at every month. Each commodity has a specific expiration date. For metals like copper, uh, gold, and then also like oil and gas, their expiration date is towards the end of the month, the last 2 weeks. And for other agricultural products like wheat, grain, their expiration dates are around the second week of the month, so around the second Wednesday of the month. And you can basically bet around this time, expiration time. You can look at the net positions of these commodities in the open market, in the futures open market, right? It's public information. So, and then you can see if the bet will be wrong, and then you can bet around the expiration time and make money, right? And yeah, so that's one way you can make money, by just betting around the times of the expiration of this futures contract. If you think that their bets are wrong and they have to go and buy in the opposite direction, right? So yeah, that's just a simple way to think about it. I know gold, I believe, among all commodities, gold right now has the biggest net position in the futures market, and it's a net long. I believe it's close to 1 million contracts long in the next few months futures contract. And yeah, so if for any reason gold prices have to, I don't know, maybe the supply and demand dynamics, whatever factors influence the gold price in the market, if for any reason gold prices have to drop significantly, that will create a short squeeze on the downside and drop prices even further. So just try to understand what's going. There are many traders who are going long on gold. They're buying buy contracts to buy gold at a specific time of the month in the future. If for some reason gold prices drop, right? What will they do? So let's say for the sake of simplicity, the they have a buy contract to buy an ounce of gold for $200. Let's put it simple. And the expiration is end of December, end of this month. And all of a sudden, for whatever economic or geopolitical event, gold prices drop suddenly sharply, and now they are looking at a loss. So gold prices are now going down to $100 or $150 an ounce. What happens? They still have to close their long position because they don't have physical delivery mechanism, right? So before the expiration of their contract at the end of December, they have to close their buy contract by selling. If the gold prices are dropping, for whatever reason, it goes down from 200 to 150, they'll want to sell because they don't want to be caught with gold prices dropping further and then having a bigger loss. to exercise, right? And that will just, so if gold prices drop a bit below 200, then all these traders now they have to close their position. It's close to expiration date. They'll rush to sell, and they're rushing, panicking to sell because they don't want a bigger loss. Will just push gold prices further down. So that's how futures forward markets basically, if the traders get their bets wrong, which they do in a lot of cases, that basically exacerbates the price movement in the direction it was already moving. So gold prices were dropping a bit, but because now all these traders are panicking, they don't want a bigger loss. They want to close and sell, buy sell contracts and close their position. And they're doing it at the same time, and it just drops more. And so this forward and futures market, in more cases than not, they basically exacerbates the price movement and volatility in the current market. So yeah, that's something I wanted to talk about in this video. If you guys like it, please feel free to share and subscribe. I'll see you guys in another video. Peace.